Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today, we're talking with George Bravante. How are you doing today, George?
I'm doing great. How are you?
Good, doing well, doing well. So, George, we're going to get into one of my favorite topic areas, but why don't you tell the listeners a little bit about your background?
Yeah, my background is a little varied. I grew up in the New York area. I went to school in the South. I started in public accounting with Pete Marwick in Charlotte, North Carolina, and then quickly moved to Newport Beach and worked for Ernst & Young. Now, shortly thereafter, I became the CFO for the Robert M. Bass Group's real estate arm in LA. Segued from there into some private equity real estate transactions, pretty significant ones. That company kind of turned into TPG and Colony Capital. I started having children, didn't want to work globally 24 hours a day anymore, and started a small investment company with a high net worth family in Newport Beach, California, and somehow landed in the Central Valley on a deal. And we had three sons, the three little boys at the time, and we decided to stay in this little farming town and live there and raise our children there. As the deal junkie personality that I am, we started investing in troubled citrus groves. And, after I got into it, I figured out the cash flow characteristics, the tax treatment, and decided to, kind of power into it. Segue 20 years later, we have farmed about 5,000 acres. We have a vertically integrated ag company. We farm it, we pack it, we sell it, we cool it. So we have basically we have a processing plant, we have a farming company, sales company, and a very good administration group that facilitates our ability to raise money. We've syndicated all along. I had nothing when I started, basically. So I needed partners to push things ahead. And, so a lot of my partners are telling me they want no more green bananas. They want yellow bananas. So I'm looking for new investors that are interested in the ag space. That's why I'm on your show today.
Oh, okay. So let's talk about kind of the ag space. So you're basically an accountant and kind of deal maker that got into farming. How is the ag space kind of set up? Are there a lot of people like you out there, or is it mostly just kind of like mom and pop, ranchers out there, kind of doing ag?
I would say, I don't know the numbers, but if you read the literature, there's about 70,000 mom and pops left in the Central Valley. There's probably 50 companies like ours or bigger. We're kind of a medium small company. So it's consolidating fairly rapidly right now, because what happens is the mom and pops, their parents started it, and then their grandkids want no part of it. So, in the 50s, 60s, 70s, you could have 30 acres and make a living off it, raise your kids, send them to college, and then those little opportunities are being consolidated into bigger opportunities. It doesn't make sense anymore to farm 30 acres. You need hundreds of acres to make it work.
Yeah. So where do you see kind of the future of the space? Because, it sounds like, a lot of farmers are, ranchers or families. And I know there's definitely kids, grandkids don't want to do it, but, it's kind of also part of the identity in a lot of these communities. So do you see these kind of big companies just kind of basically mopping up all of these properties and just having big conglomerates? Or do you think there'll still be kind of small family farms?
I don't think there'll be many small family farms under 100 acres. It just doesn't you can't make enough money to raise a family anymore on 100 acres. And, or some commodities you could, but if you're, my sense is if you're not in it, it's hard to make optimal returns, right? You need, if you're hiring an outside guy to farm, an outside guy to pack, and an outside guy to do your insurance, it just costs more. It's not efficient. So, and there's just not a lot of people who want to make their life in it anymore like there were.
So what do you think the minimum number of acres is to make it kind of a viable enterprise?
I think we could do in our business, we're fully integrated. We could do as small as 20 acres and make it work because we just aggregate it with everything we're doing. But if you're an individual, it's got to be 100 acres or more to make it kind of viable.
Okay. And then, I would imagine it's dependent somewhat on the type of crops. So, kind of, how would you differentiate the types of crops that people can look at?
I mean, in the South Valley where we are, it's nuts, pistachios, almonds are popular, walnuts are going away. They're all in kind of bankruptcy now. And table grapes are big, wine grapes are big. Citrus is huge as where we are. It's kind of what it's famous for around here. So, there's everything in between. There's little guys that do strawberries in the springtime. There's lettuce. I mean, there's just, but the big major crops are what I just described.
Okay. So, I mean, what do you focus on? Like when you're looking at crops, do you have?
Well, I mean, we basically do table grapes and citrus. We do all the citrus varieties. We do all the grape varieties. We have some pistachios. We have some wine grapes that we do just because it was a good buy years ago. But our main focus is grapes and citrus.
Okay. And so I mean, it sounds like you've done a good job of kind of building out the machine, if you will, to do this. How does, is this something that people could get into now and start doing what you're doing, or is there like still opportunity there?
I mean, when I started, I was buying the ranches at 1,000 to 2,000 an acre. Now they're 40. I mean,
Wow.
it was a little more distressed back then. And you need to get the critical mass in my mind to have the infrastructure to do it. I think there are people that do buy ranches up here and then outsource everything. I don't think they're as successful doing that because, everybody takes a little pound of flesh for every service they provide. You add it all together, the returns are too small. It's a pretty competitive business already. So
okay. So I know pretty much up until the last few years, the ag space was was a redheaded stepchild in the financial industry. Nobody was interested. Nobody wanted to invest in it. Commodities were cheap. I imagine the margins were slim. How did you manage to kind of get through that when everyone else was kind of struggling? I mean, institutional investors had no interest at all.
Well, I mean, you're talking about commodities more than what we do, right? I mean,
right,
you're talking about corn and soybean. I mean, in the fresh fruit market, the last 20 years have been extraordinarily good returns.
So you're suggesting that the like citrus, I haven't looked at the chart, but things like citrus and grapes were fine. I mean, because I'm not talking about just soybean and corn. I'm talking about like a lot of commodities. I mean, people didn't touch commodities in the institutional world. Like it used to be a third asset class: stocks, bonds, commodities. In the last 20 years, people just got rid of the commodities. It was just stocks and bonds because the returns stunk.
Yeah. I think that's right. I mean, in what we do, it doesn't correlate like that. I mean, there's not a lot of people that report on it, right? It's just a different kind of deal. Families don't tell you anything. I mean, for instance, in mandarins, the cuties you see in the store, or halos, the little bags of tiny, mandarins. You've seen that in the store, right?
Yeah.
Well, I mean, we're in those, example, I had a 100-acre ranch that does that. I mean, we're making 100% of our money a year on those ranches. We're making $10,000-$15,000 an acre. So you lever that 50%. I mean, so not every year, but I mean, in citrus, you're making, and in grapes. I mean, the grape thing, since Trump put the tariffs on, has been a little bit unwieldy because we used to ship 40% of it to Asia and most of it to China. So that's taken the grapes have been a little tougher since that happened. But most ag product, I mean, we're making big returns on a cap rate basis on this stuff forever. I've been doing it for 20 years. I made it every year for 20 years. I mean, some years you might have a weather effect that kind of blows it up on different ranches or something, but the returns are fairly significant, again, compared to, the commoditized, the people that track that stuff. I mean, it's not, it's not the same thing at all.
Are you seeing institutional interest in the space? Because for me, I've always been puzzled as to, I know that I've started to see some now, but when did that pick up?
Prudential and some of the key players have been doing it for 30 years. I mean, they've been more focused on almonds and pistachios and more kind of institutional, easy to grow crops. It's easy to grow nuts, right? You fertilize them, you irrigate them, then a machine comes in and shakes them off and takes them away. And what we do, it's more labor intensive. Farming costs are higher. I mean, till the almond thing was oversupplied the last couple of years, it was like the poster child for agriculture in California. I mean, it made so much freaking money, no one could believe it. Now they're up to 2 billion pounds a year, and they're starting to choke on it a little bit. So, but I mean, put it this way, if you're not making 10 to 15% current on what we do, you got a problem. You need to, and that's based on, on these newer prices, where the prices are much higher. It might be 5 to 8% on those numbers. Like we just sold, we had a little private equity fund that we did 12 years ago that ended in 10 years. So we just sold 300 acres to Prudential Insurance. And most of it was mandarins, and they paid like $65,000 an acre for the mandarins, a record price kind of. They're looking at it from an ROI point of view, like what's the long-term return? Every other ranch I bought or sold in the last 25 years has been based on a per acre price, not on a cap rate or a return basis. Just what's the market? What do you think it's worth? So, I mean, the institutional guys have seen that and they're starting to move in here. There's been 4 or 5 really large transactions in the space, like $500-600 million worth of private equity coming into the valley, buying families out of like different segments, different things, but big numbers. I don't think they're doing so hot with it because, they're kind of very analytical, not so much on the soft side of farming and understanding it. They're having a little bit of trouble with it, but there's a lot of interest, and based on the cash flow, there's a lot of institutional investors that are looking at it pretty hard.
So at what price point does it stop to make sense to buy farmland out there? As you said, you're obviously making big profits, and 65,000 acres, the top price that people have paid. But, as long as people are making a return, I would imagine they keep bidding up the price.
Yeah, I mean, I think it's a tale of two cities almost, right? I mean, individual farmers, guys, you see 70,000 families out there to own 20 acres. They're not thinking about returns. They're thinking about how much can I get an acre and can I get to a retirement home with the money I get, right? And then you got the bigger players that are thinking, Prudential is going to own it for 100 years. So let's get in now, pay a little more, and ride it into the sunset. I mean, my belief is the reason I'm 63 years old. I've got a pretty nice portfolio. I built my net worth and my life through this stuff. I see a big opportunity in these really good water districts that are around Fresno. That since California has mandated this Sustainable Groundwater Act in 2014, a lot of the state is going to go dry that has been pumping deeper and deeper and deeper.
Yeah.
So our program is going to the area where the water's bulletproof, the soil's bulletproof, the microclimate's bulletproof, paying a little bit more, but riding that from 35 to 40,000 to 100,000 in the next 10 to 15 years. Kind of that's where the action is in my mind.
Okay. Now, it seems like you're more focused on like permanent crops rather than row crops. So, what are some of the risks that are involved with that?
I mean, the risks are obviously pest, right? I mean, if you had something bad happen with some pest, you could lose your branch, right? That's be bad. We combat that pretty effectively. We haven't seen that ever. We've got climate change risk, right? The weather being a little crazy, right? More hail, more things like that, more freezes. And then, I think another at risk is, the geopolitical world we live in where the U.S. doesn't protect farmers and all the other countries protect their farmers. So we're at a little bit of a disadvantage. Every country we ship to has tariffs, making sure we don't come in before a certain date to protect the people there that do the farming there. In the U.S., the government doesn't believe in that for some reason. Anybody can come in here whenever they want. So different crops are affected by that, in South America, basically. But, I think that, overall, where we are is one of the best places in the world to do this based on the different climate stuff we have. For instance, on citrus, you need cold winters and hot summers to make the citrus eat good and produce a big enough crop to make it viable. On nuts, you need really cold dormancy in the winter to make the trees work. I mean, the Central Valley is a very unique microcosm of this really good weather for farming and great water in most places, great soil conditions. So, I mean, it's a unique place to do it. Actually, I think it's got a pretty good future.
Okay. So, when you think about, you've obviously put some time into kind of like vertically integrating your company to, squeeze out the profits all the way up. Are there any kind of future plans or things that you kind of worry about and you think, oh, at some point I want to do this because it will solve this other problem?
The only thing I'm really looking at more is like more automation in our facilities. Like, it's very expensive to put these self-palletizing robots in. But that's something we need to do because that's, palletizing, people don't think about putting the boxes on a pallet to ship them. That's labor intensive and it costs a lot of money. As the labor gets less skilled and less caring, those mundane jobs we need to automate. And so that's the thing I think we need to do that we haven't done as much of as we could. On the packing and grading, like for instance, Korea is a big market for oranges, right? They buy more oranges per capita than the rest of the country combined, probably countries in the world combined. They pay $2 to $3 more on a 20 box of fruit, 20-pound box of fruit. If you can tell them what the sugar is in it. So like on our pack line here for citrus, we have Brix detection. So it puts a high intensity beam of light through every orange and tells you how many sugars in it. So the high sugar goes to Korea and the rest goes to the US. So, I mean, there's a little bit of stuff that we've invested in those kind of things, detection of, blemishes and stuff on the fruit. We've got high tech for that, optical sorting and optical grading. So, I mean, they're the things that we need to keep investing in because labor just keeps on going up and the labor quality is not as good as it used to be.
So let me ask you, because you mentioned you do a lot of syndications. I mean, if these deals are so good, why take outside investors? Why not just borrow money or use your own money?
Well, the borrowing thing, I think in my mind, part of my success has been I never have levered the ranches up that I own. So if you looked at Wells Fargo, they're always trying to get me to borrow more money because I'm probably 17% LTV on 3,000 acres. And I just don't want to, I just don't want to be at risk. In each of these deals, I'm putting up 10% of the money, which is 200,000 to 500,000, which for me is a lot. I have a high net worth, but I have no money. Everything. I've got a lot of money in these ranches and in the facility and all that. So, I've always syndicated, and I don't know. I don't have a significant net worth cash wise. I've got some cash obviously over the years, but I mean, I don't, you know what I mean? I just don't have it to do that. And I don't want to lever my stuff up to buy new stuff. So yeah, that's the reason.
Yeah, no, I'm just curious with the leverage part because I know the Farm Bureau Association, FBA, or whatever it is. I know they have really low rates. And I don't know what they are now, but I mean, a year ago they were like 2% or something crazy.
Yeah, it's been great the last 10 years. All of a sudden we have a little shock going on. Everybody's money. I mean, money's still really cheap relatively to the 80s.
Yeah,
right. But cheap. I mean, it's like everybody's freaking out because they're paying like 6-7% now. So I mean, again, I just have never levered up on all the stuff that I own. We own all of our homes. We own all of our cars. We own. I'm just not a big leverage guy.
Yeah. Okay. Yeah. I was just curious. So, and in kind of going down this path, I'm sure you've had made a few mistakes along the way. What are some things that in hindsight you'd kind of go back and be like, oh, I wish I did this differently when I was kind of growing this enterprise?
My real things that I think about, I kick myself over, is that we weren't more aggressive on putting these ranches together when they were a lot cheaper. You know what I mean? Wasn't aggressive. I just found I was too picky on what I was buying. make sure it was perfect. And I missed a lot of good transactions. Um, I mean, we designed the packing house. I didn't make it big enough. We've had to expand it, which costs a lot more than doing it at the beginning. Um, another thing too is like, one thing I've really learned is, this will sound crazy, but in the beginning, I always hired all the experts for everything, the farming, the selling, the packing. And what I've learned is, doing it myself with my own staff, where the people answer to me and care about our company, we do so much better. It's just, having people that don't work for you. I mean, like for instance, we had a big ranch and we had a guy doing farming and packing the table grapes on it, but he worked for himself and he didn't work for me. But so he was like we were a customer. Guy was playing golf half the time. You know what I mean? It was not good for me. And I thought I needed him because I didn't feel like I knew enough. And in retrospect, I was a moron. I should have just taken it over, hired the people myself, did it myself. I'm in the field all the time. I could do it just as well as he could do it. And, that was a big mistake in my mind because we didn't make as much money as we could have with a guy who was not vested in our business. So things like that more so. I mean, this is not a complicated business, right? It's a business of nickels and dimes, making sure you have your eye on the ball and you're focused and you don't take any extraordinary risk and you're current on everything. And, I mean, for instance, like the mandarins we grow quite a few mandarins. They all go to Sun Pacific and end up in those cutie containers. The reason is he's the best in the world at this. The guy who owns that Sun Pacific company, he invented it. He's the best. He makes the highest returns. We have other ranches that got pomelos on them, which are Asian grapefruit. We can sell those. We wouldn't make half the money as the guys who are really good at it do. So not only do we pack it ourselves and vertically integrated, but we reach outside to the very best at what they do and make extra money to the ranch. Our whole concept is how much money can we drive to the bottom line of the ranches? Because packing fruit is not a profitable business. You make a little bit of money, but then you turn around and invest it in, new equipment. You're not really making anything. Really, how much the properties make is where you make the money.
Have you considered putting all these together in like a REIT or a fund?
It sounds kind of good in a way, but I've got so many different partners and stuff. I don't know how we'd ever do it. And I kind of like the idea the ranches stand on their own, and then there's no onerous overhead. You do a REIT, it's just really expensive to do those things. I mean, we are very efficient at this, owning it as we do. And I don't see the benefit of the REIT. I'm on the board of a REIT. I'm on the board of some company. My days in private equity, those people asked me to be on boards of some of the bigger, public companies and stuff. It's just so expensive to be in that space. And if we put everything together, it'd be $200-300 million, and that's still too small. Even if you wanted to do it, it wouldn't come out, I don't think.
Okay. All right. Well, as we kind of wrap it up here, what are some kind of final thoughts you can leave our audience with for the farming space?
What I tell people is, if I think everybody should have a little bit of ag in their portfolio if they're open to it. I mean, depreciation's 2 to 4% a year. The current comp is pretty good. It's a good diversification tool. I mean, I'm 100% in it, which is probably crazy, but I think it's a good space for people. It's very safe, and over time it ebbs and flows. But I mean, it's like we're seeing the inflationary cycle pushing these prices up higher and higher. Kind of another reason I did it years ago. I felt like it was a kind of a hedge against inflation for me as and my family. So.
Okay. Cool. Well, George, where can people find more about you?
We have a website called BravanteFarmCapital.com. And we're offering different transactions. We have a new one coming out in the next month or so. So if they were interested in maybe not investing, but learning what investment looks like, they could go there and sign up for our deal and see what it is. We have it's like a 140-acre ranch of citrus and table grapes, really clean sheet. We developed the whole thing ourselves. pretty safe and good opportunity. So they could go there and they could find out about it and interest in, knowing something about it and potentially investing in it with us. Our minimum investment is 25,000. Our average investment is about 100,000, but our minimum is 25. It's easy. One of the things I like is, I'm like pretty passionate about what I do, and I love what I do, and I love making consumers like our fruit and all that. But I would love to have more ordinary people invest with us that aren't rich people. I grew up, my dad was a mailman. I'm kind of a common guy in a way, and I kind of like to see people that are young people, especially if they have a little bit of money, kind of join what we do and ride it into their future. So anyway.
Awesome. Well, George, I really appreciate you joining us on the show and sharing your wisdom with us. And we'll probably have you back on in the future, because I don't think this trend's going away.
Yeah, man. Well, hey, thanks for your time. I really appreciate it. Take care.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist, because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room, as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with George. Really appreciate him coming on the show. Another great topic I love talking about that no one's really talking about except for us, which is farmland. So really appreciate him sharing his wisdom with us. Now we're into the panel portion of the show where we have our very own Doug Heagren. Hey, Doug.
Hey, Kirk. Good morning. How you doing today?
Doing great.
You're out there on the East Coast. How's weather?
It's raining once again. It's springtime, and my allergies are crazy. I'm itching the eyes out of my head. I can't stop sneezing, and it's raining. So what could be better, Doug?
Sun, but vitamin D. But at least you got the ocean, so that gotta love that part of it.
And we have our very own Barb Friedberg. Hey, Doug. Hey, Barb.
I'm here too. Brought my allergies as well, so maybe we can get a sponsorship from one of those pharmaceutical companies.
They've got plenty of money to spend, and they're more than willing to solicit us some things we don't need. So thanks for the recommendation, Barb.
But Kirk, do they have as much money as J.P. Morgan Chase, which I was just buying failed banks with the government government's help and guidance. So anyway, that's a topic for a different day today. But
we'll have to talk about it this Friday, Doug, because and actually this episode is going to come out much later, so people are going to be like, "What are you talking about, Doug? That happened like 6 months ago." I'm like, "Yeah."
Hold on, let me back up, Kirk. So for those of you watching now, back up to our past episode from May. What is it going to be? May 6th. Whatever
May 5th.
Yeah, Cinco de Mayo, right?
Yes, it's wonderful, and I have to say that JP Morgan is the new Warren Buffett, where he just sits around with a pile of money and waits for people to fail and comes in and swoops them up, because that's what they've done since 2008, and brilliant business model. So give him high fives, virtual high fives, JP Morgan.
Well, Jamie Dimon came out and said that the banks will never, the bank system will never fail as long as he's alive.
Yeah.
I don't know if that means, if something happens between now and the recording and Jamie Dimon ends up a little bit more like an Epstein, I don't know. Just tie it back to that comment. Moving on. That's not the topic for today. So,
but as they say in the Highlander, there can be only one. So as we get into this, so Barb, let's get your thoughts on the episode. What are some of your thoughts on the episode, Barb?
Farmland is really an asset class that is getting a little more media today in the mainstream area than it has in the past, because let's face it, most of us, if we want to invest in real estate, we're going to go out, we're going to buy a home, fix it up and flip it, or rent it out, or invest in a real estate REIT, or something like that. Farmland, not so much. Look, I live in California. I'm not going to drive an hour and a half to Central Valley and look around and buy a farm. But from how George tells it, it's a decent way to get some cash flow, some capital appreciation. And of course, he's offering a syndicate, like many of our guests are also, they've got an opportunity, have opportunities for you to invest with them. I'm not saying that's good or bad, but it's just another venue for investing. Now, whether it's right for you or not, that's for you to decide. We like to give you information, introduce you to ideas, and then you make up your own mind. For me, maybe it's interesting, chance to make some money theoretically, but so that's my take.
Okay, cool. So Doug, what about you? What are some of your takeaways?
Well, Barb is out there in California because she's nuts, specifically almonds, right? But it's an interesting thing. I think there's been an old saying, right, that land, they're not making more of it, right? And they've been using that for an argument forever, which is obviously why there's we've seen such a tremendous push into real estate, and a lot of people thinking real estate is the incredible, the end all be all of investing over the last 10, 15 years, as you could get money for nothing, a Dire Straits, clip there. But ultimately, that's what it's been with real estate. And California does have incredible soil, incredible agricultural. I mean, there's, how much, I don't know how much of the agricultural GDP comes out of California alone, right? And he talked about citrus, and there's only one other place I think of citrus is Florida. It reminds me of a story that, and I'm going to butcher this, and it'd probably be a good person to get on or talk to sometime. But this gentleman I knew that was a commercial mortgage lender in Colorado. And he was telling me a story about a gentleman that he was worked with, he helped to secure. And this person wanted to come up with he wanted to take on the olive oil industry. So this may be one of those olive oils that's out there now that we're finding that is actually certified and clean. Because for those of you listening, I don't know if you know that olive oil is one of the most corrupt industries out there. A lot of the olive oil you buy isn't even olive oil. And he knew that. So what he wanted to do is he wanted to start growing olive trees, and he wanted to make olive oil, a really authentic 100% olive oil. And I can't remember how the deal went, but he was able to secure a deal in which he found this land that nobody wanted. It didn't look like it was, it was good for farming or anything. But he didn't tell anybody why, but he bought the land, and he immediately was able to resell the land in a transaction to someone else, and made a multi-million-dollar profit off this land in two-step transactions. It's incredible, because all he wanted to do was lease the land to do olive oil for the future, but he made a ton off of this arbitrage off this land out there in California. Farming, and now as we're getting into a society like you talked about, with commodities getting more and more expensive, and food prices and food demand becoming greater and greater, I mean, there's no question that farming is in an interesting place to be. It's certainly in an area that, an economy that's going to probably see its boom cycle here for a sustainable while, because we need more food. We need to produce more food. And there's only so many good places to actually, to do agriculture and grow food for. Now, when it comes down to actually buying it, unfortunately, the price per acreage on farming has gone through the roof as it is. It's incredibly expensive. So I do think when you talk about like the average farmer, the next generation, we're dealing with this in Wisconsin. I know people that have got hundreds of acres that the kids live in the cities. They don't want it now, right? So, so they're getting older. They're not able to farm it. So the next generation's inheriting it, but they don't want to know what to do with it. I mean, and now you've got to get enough money if you're going to lease someone else to do it to cover the cost of maintaining that property, which is one thing if you inherit it, but it's another thing if you buy it at this price per acreage. The break even on that is something that I still, even with agricultural prices going up and the commodity of those goods you're selling going up, the cost of acquiring and making a return on investment of that is, and the barrier of entry of acquiring it in the first place is something I think is incredibly challenging for most people.
Yeah, no, appreciate that, Doug. And so Barb, what as we kind of talk about farming, I mean, farming is one of these areas where there's so much potential, and yet the numbers, farming is not something you make billions of dollars in. And I remember who was it? Jim Rogers used to say the next class of millionaires are going to be farmers, and I think that has never come to pass. I'm sure it's possible, but the numbers just don't make a whole lot of sense. So how can people get into farming in a way that like the average retail investor, like I want to add farming to my portfolio, but what do I have to do? I have to go buy land, I have to go farm it, I have to do all this stuff, and I'm not an expert. So what would you recommend people do to kind of get into farming if they wanted to?
Well, when I moved to California about 12 years ago, and I thought, okay, now's the time. I'm going to start growing my own crops. Long story short, my local Safeway is in no trouble of losing me as a customer. So to get into farming, there are ways now for smaller investors to actually own a swath of a farm. And these are the apps. The new crowdfunding trend, which we've talked about a lot, I've covered a lot on my RoboAdvisor Pros, is these smart, experienced, hopefully entrepreneurs who have some knowledge in a certain area would develop a product so that you, the consumer, or myself, can buy a piece of a farm. Two of them that I've actually studied in depth and actually have a YouTube video with the founder of one, Farm Together and Acre Trader. I believe they're both for accredited investors, which means, you do have to meet certain income or knowledge or net worth criteria, but they enable you to get into a farm, own part of a farm for $10,000, which obviously is not for a newbie, but for someone who's in their, the mid ranges of their lives, they can probably swing that. And then you get both cash flow and you get capital appreciation. Now, am I touting these? No, I'm not. I'm not touting anything because that's not what we do here. I'm introducing you to a place where you can get in on farming for a smaller percentage. The returns looked pretty good on their website. I'm not going to vouch for them. There are other apps, that farming or agriculture apps that I've heard of as well. Rich Uncles is another one. I don't know about that one as well. But that's a way for the ordinary person with, a modicum of income, wealth, whatever, can actually get into this asset class. We know diversification is important, and maybe farmland would be a place where you can diversify for not too much money.
Yeah. So, I know in the public companies, it's really only two that I'm aware of that are farmland. But Doug, how would you look at this space? Would you invest in the space? Like, how would you go about it? Like, what are your thoughts when you think about farmland as an asset class?
I think farmland as an asset class is I think it's a good thing to hold as potentially part of a portfolio. I wouldn't dive all in on it because I think the biggest issue that you have with it is going to be is liquidity. Okay, and it's the same thing with a lot of different direct commodities. Now you can go if there's an ETF out there, and I don't know of any off the top of my head. I haven't looked. An ETF that doesn't farmland, then liquidity is not going to be an issue. But there's pros and cons of investing in that. And if it's an ETF, you might not actually be investing in the hard land. You might be investing in just futures, which is completely different. It's no different than an ETF that might buy gold. Are you really owning gold? No, you might be investing just in the futures. So if you're going to get into some of these things, and the reason they're for accredited investors, whether you're going to buy the land directly or whether you're going to buy the land through them, they're basically, the preface is you've got to be able to have enough liquidity to be able to deal with the other things in your life that are going to be financially needed. They're not, if you're holding actual farmland, that's not going to be easily sold except through a broker. If you're in one of these REITs or other types of platforms, there may be a penalty to try to liquidate early, and there may actually be a caveat that doesn't allow you to, except under approved redemption. So I think that's an area that is going to be a negative. Now, where can it play? So just to kind of look, I'm looking at, ironically, thecollegeinvestor.com has an article on how to invest in farmland, and they were doing some detail on this. And I would, if you were to look at this as a piece of your real estate, I mean, what kind of real estates are out there? You've got residential real estate, got commercial real estate, you've got, and then this would be another piece of it. And historically, it seems like it has done fairly well. So between 2008 and 2018, compared to the S&P 500 that returned 13.1% annualized return, the farmland index returned 11.2 annualized return. However, between 2007 and 2010, farmland didn't produce any negative returns. In fact, in 1991, they're saying that it only had one negative return in Q1 2001, where it delivered negative 0.01%. Whereas, again, stocks during 2008, they dropped by 52%. And, during that, the farmland, the NCRIEF Farmland Property Index between Q4 2007 and Q1 2010, it continued to produce positive returns every quarter. The fourth quarter of 2008 specifically, which was the worst quarter for stocks, farmland returned 7.33%. Okay. So if we balance out the returns it's gotten, and we compare that to some of the volatility that you might get in your other investments, when paired together, it could be another holding in there that can help to potentially stabilize portfolios. And I want to stress, hope to, because there's also the possibility that it can have its period of negative returns, and for whatever reasons, maybe due to interest rates, maybe due to technology, who knows what could occur there. So again, and also the fact that it's potentially illiquid is why I would never, unless it's going to be your core business, it's not something that I would go into and just dive in thinking, look at those past returns and how much money I can make. Because as we know, past is not indicative of the future. But again, as part of maybe an asset slice of real estate, farmland, we're going to need food. It's got to be produced somewhere. Population keeps growing, which means there's going to have to be more production. There's areas of farmland that are continuing to get worse and worse nutritionally, which means, depending on the economy or the environment and the climate, they may have to concentrate farming in different ways that may continue to make farmland obviously something that is, a highly desired and highly appreciating asset. But who's to say? So I would definitely look at it, but I wouldn't go all in.
Yeah, I mean, one thing that I've been fascinated about with farmland is if you think about different aspects of it. So you look at the show like Yellowstone, and they're basically in cattle. And if you go out to Montana, and I've been out there, it's beautiful place, but it's basically cattle farming. And maybe they grow hay, but they don't really grow anything else. The soil's not really meant to grow much else, and it's a low margin business. Basically, people out there are barely surviving. Their farming is basically sustaining their way of life, but it's not making them rich. And even the people with thousands of acres and tracts of acres, they're not wealthy, right? It's interesting. And then you have other people that go into vineyards, right? And if you have a top vineyard, like in France or wherever, like you can make some money, but it's not really how you build your wealth. So I look at farming as an interesting category because a lot of people look at it as a way to create legacy wealth and inflation proof wealth. And, just like the ultra high net worth families that are investing in real estate as a way to hedge against inflation. You got people like Bill Gates that are buying, I think if he's not the largest landowner, he's one of the largest landowners now because he's bought so much farmland. But I know people kind of put, they try to connect the dots and create some big conspiracy. But the reality is that farmland is still a great way to hedge against inflation. I think it's a question of whether it's profitable, and it comes down to the commodity that you're farming. So, Barb, if you're looking at, I want to kind of, as a portfolio manager standpoint, let's put on your portfolio manager's hat. If you look at farming, right? So farming is a commodity, and as a commodity, it means that people are consistently trying to drive down costs, and they're trying to squeeze out margins, and there's new technology coming out. And at what point is there a point with a commodity like this where it actually becomes reasonable to look at it as a good investment? And obviously it depends on the kind of commodity we're talking about, whether it's grapes, or whether it's citrus, or whether it's nuts, or whatever it might be. Is there a point where you'd say, yeah, this makes a lot of sense, or is it just kind of like it's just too hard to do on your own?
Every investment can be a good investment if you buy it at the right price. So valuations matter. To value the public company or the stock market, the S&P 500, it's pretty easy because they're public. All their, the majority of the information about the company is readily available. So you can analyze how much you're going to pay for $1 of earnings for a company. So it's easy to value a company, or easier to value a company or an index than it is to value a farm. And one of the things I was struck by with George, our guest, was he said the cost of land has gone through the roof. Immediately, a light bulb went off, which is, if I'm buying a new farm and my fixed cost or my initial cost has gone catapulted, that raises the question, obviously my return is going to go down unless there's some magic I'm missing about how the profits are going to keep up with the costs. So number one, look at the valuation of what you're getting and compare that with the potential return that you're promised. Projections are only that, they are projections. There's another concern that investors want to think about, which is the competitive landscape or environment. Who else is in this sphere? Well, we all know that farming has become a home to a lot of huge conglomerate, big investment companies who are now farming big swaths of the U.S. agriculture market. So the question is, you, little Jane or little Joe, buying into individual farms, are you going to be able to compete with those bigger players? And that's an unknown. I don't have the answer to that, but that's another portfolio manager type of question that you want to ask before you go into an investment. And Doug, you were talking about, well, where can you get access to this on public markets? Well, I'd say you might want to look at who are these big public companies that are investing in farmland. Maybe that's a way you can get into farming with more liquidity and going with a bigger company who might have more resources and the ability to squeeze out greater profits. So like anything else, do your homework, do your research, and any investment, I suggest don't make it a full part of your portfolio, because there's a bit of comfort in knowing you're diversified, because as Doug has said, and we've all said, you've got to hate one portion of your portfolio or you're not diversified. You need enough eggs in your basket, so if one of them cracks, you have nothing, you're not left with nothing to eat.
Well, the price of eggs nowadays, Barb, they're coming down, but We can't crack any eggs. Gotta keep those. So, what I find interesting is when I think about investing, I started kind of like, and maybe this is a good framework to integrate for the show, is when I think about investing, all three of us kind of look at it a little bit differently. But I start at a high level and I think like, all right, what am I missing here? So the question that comes to mind with farmland, and I'm just being a little bit devil's advocate to myself, is there's only, as far as I know, there's only two publicly traded farmland investments. So I'll tell you what they are: Farmland Partners, FPI, and there's LAND, which is Gladstone Land Corp. They're both run by smart people, right? And Gladstone has a bunch of different properties, different, and there might be other farmlands, but those are the ones that I'm aware of. Now, if you'd think it was a really profitable category and there was a lot of interest there, you'd have more than two, right? You'd probably have a ton of them in publicly traded companies, and you'd have some REITs, and you'd have all these different, investment assets. Because as you know, Wall Street likes to make money. And if there's a profit to be had, they're going to squeeze every nickel out of it because that's what they do, right? And love them or hate them, that's just who they are. So the puzzle to me is, why aren't there more? That's the first question I asked. And, if it's so profitable, then there would be more. Even though these two are run by smart people, and I give them a lot of credit because they would not put money up if they didn't make money, right? But the other question is, you've got these enormous tracts of land in the US that are owned by private farmers. And frankly, I know they have no interest in going public because it's a different way of life, right? So that's kind of the other side of the coin. But it does make me wonder, because commodity prices do go up and down, and the institutional research firms don't have a farmland desk. Every once in a while, I know there's one analyst that's really well known. She's really bright, and she bops around to different firms because she gets a job, and then they realize there's no interest from their clients, so they kind of let her go. And it's not because she's not smart; she's really smart. I've talked to her a bunch of times, but there's no market, there's no interest in it. So I guess it kind of raises the question of like, what's going to generate that interest in farmland? What's it going to take for the industry to say, hey, farmland's a real asset class, stocks, bonds versus stocks, bonds, and commodities, which is the way it used to be. So I don't know. What are your thoughts, Doug? Like, what's from an industry perspective, how would you look at it and say, well, obviously there's something missing here? Like, I don't know. What are kind of some of your thoughts?
Yeah. I don't really have a really good thought as to why there hasn't been a great investment into it, because generally everything else out there that you see, somebody's lining up to if there's money to be made on it, somebody's lining up to package it and sell it to someone. I think one of the things that might be the challenge again with this is the liquidity issue. And there is still, and I forget, you had another person that was recorded that you talked to about a year ago, was talking about the amount of farmland that's still owned personally in families. There's still quite a bit. So, and that is getting handed down. Now, what's going to happen with the next generation of that, it remains to be seen. And the thing about farming, and you alluded to it, a couple minutes ago, it's very low margin, right? It's you've got to have the land, and then on top of the land, it takes a lot to maintain. I mean, it's one thing if I'm going to buy acreage, of land that we're going to go up and hunt or, hang out and hike. I can let that do whatever I want. But farmland, you've got to constantly rotate crops. You've got to constantly adjust the soil right now. So one of the best performing stocks over the last several years is CF Industries. CF Industries is located right here in my backyard in Minnesota. They have almost a monopoly on anhydrous ammonia. Okay. Anhydrous ammonia is basically a chemical injected into the ground to synthetically create nutrient in the soil. Right. And it is under massive demand. And because of COVID and the shutdown, all it did was take the price of anhydrous ammonia through the roof. So if you're a farmer, you've got to pay top incredible dollar to be able to buy enough anhydrous ammonia. As a matter of fact, there were shortages, right, in order to be able to have the nutrients in your soil. Then you got to rotate the different crops because you can't plant the same things. Then you got to go out there. I was just looking at the price of a harvester. Harvesters can run 100,000 to 500,000. I've seen $1 million harvesters, right? It's not the old days where you just got an ox and a plow, right? So there's a tremendous amount of investment and upkeep that has to go into maintaining these things, which makes those profits lower. Grocery stores are similar. I look at the amount of, the price of profit the grocery stores make, it's all in volume. So if you're going to be out there trying to make money in this, it's going to come down to like Bill Gates level ownership of land in order to have enough profitability. And we've talked a number of times here, Kirk, over the last year or so, about investment capital, venture capital. What's one of the things that came out of this was that companies don't like to invest in profitable companies, boring companies. They like to invest in growth and opportunity and big name. And if it's illiquid, so it's hard to get rid of, if it's not incredibly profitable, but it's still profitable and boring profitable, and there's a lot of upkeep, it's just probably not a lot of that excitement. There's only so many dollars to be invested. And guess what? We know where the majority of investment money's gone over the last decade: tech. And that means that money has to be pulled from investments in other areas. And I think that as much as, sure, our food prices are going up, the cost to create that food in the first place is going up as well. So I don't have the numbers in front of me, but it's a hard work. It's expensive. It's got to be maintained. It's not people say, well, it's passive income. I love when people say real estate is passive income. No, it's not. If I got woods, I got hunting land, sure, that's passive. If I own a house, I'm dealing with stuff in my own house right now. We got settling, we've got drainage, we got a roof, we've got gutters, we've got this, we got weeds. It's not passive by any means. So to me, it's just, it may be opportunity there, but I don't know if those margins, even though the prices are going up on the revenue, is the profit going up with it is a question. And is it just more hassle than it's worth for investors to get into because it's incredibly cumbersome to maintain?
Yeah, no, I think it's good insight. So as we kind of get ready to wrap it up here, Barb, what are some final thoughts from you that our listeners can take away from this, and where can people find more about you?
I think you can make money in a variety of places through investing. Agriculture investing is one of those. So do your own research, figure out what areas of investing you want to put your time and effort in. If you don't want to do any of this, hire a financial advisor or a robo-advisor. I am Barbara Friedberg. You can find me at Robo-Advisor Pros, Barbara Friedberg Personal Finance, and on YouTube. See you next time. Bye.
Great. Thanks, Barb. And for anyone who wants to buy a vineyard or winery in California, let the three of us know. We'll happily be your beef eaters. Barb's already there, but I'm sure she'll save us a seat at the table. So Doug, what about you? Final thoughts from you, and where can people find more about you?
You talked about vineyards, and I knew some individuals who made a lot of money. One of them was a former vice president of Ameriprise that kind of, as Ameriprise got spun off American Express Financial Advisors, he became multi-millionaire. And one of the things that he was joking about is he took that money to invest in wineries. And he said, look, I didn't invest in wineries to make money, right? It's like, matter of fact, everybody joked with him. Invest in wineries to lose money. It's a passion business. And you've said you can make money in it. But again, we come back to the amount of work it takes to truly make farmland productive and the cost that goes into it. That, unless it's a passion of yours, I certainly would hesitate against anybody going out there and just acquiring farmland unless you have a really defined business plan for how you might lease that land out, or you really are trying to place, like you talk about generation wealth, a place to place your money that is over time certainly going to appreciate, but you're going to have to maybe understand that while you're holding on to it, your profitability may be questionable. If you want to get into it from a liquid standpoint for the average person, I just looked up a couple of ETFs. I am not promoting any of these ETFs. I don't know if they're good or bad, but they do have exposure to farmland. One's got a ticker DBA, another ticker is corn, and another ticker is tags, TAGS. Okay, so there's some things to look in here, but do your research. And that's really, for the average person, you again, lending's down. You're not going to go to a bank and get money and financing to buy. You know, a lot of these farmland companies are credited, so most people can't afford to get into those either. So that may be your best way to expose it. But do I think that it is a good potential thing to have as part of your portfolio? I do. Why? Because it's different. And if it's different, then it's going to give you an opportunity to potentially have some reverse or at least non-correlation to the rest of stuff. And again, it might not be sexy, but you know, again, when you need it, it might be. And that's what we talked about. Barb said, look, if you don't like something right now in your portfolio, well, then you're not diversified. Listen, I just wanted to say from finding more about me, go to procollegeplanners.com, download our checklist. I just had someone listening to these podcasts reach out. They want to make sure they're planning. You might have kids that are 6, 7, 10 years old. A lot of people think about college planning when they're kids in high school. There's a plan for that. There's a strategy for that, picking the right school. But you know what? It doesn't matter how old your kids are. It's never too soon to start saving for college. And it's a lot easier to save today than it will be even tomorrow. So reach out to learn, get our free checklist, learn more about how you can be prepared to send your kid to the right school for them at the right cost. procollegeplanners.com. Douglas Heagren. Thanks, Kirk.
Great. Thanks for coming on, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.